Welcome back to Furtitude Flow, the podcast. Today's guest is Pierre Fadal, founder and managing director of Square Associates, a Singapore-based advisory and investment firm focused on emerging markets, geopolitics, and global capital strategy. Pierre has spent more than 20 years working across international finance with institutions including Deutsche Bank, BNP Paribas, Aberdeen Asset Management, and Tokio Marine Asset Management. With deep experience in Asia, credit markets, private equity, and macro investment. Today we are diving into China, the Gulf conflict, Taiwan, gold versus crypto, geopolitical risk, and how family offices can position themselves for the next 6 to 12 months. Pierre, welcome to Fortitude Flow.
Thank you, Frederick, for the invite. Pleasure to be here.
Such an honor to have someone with your expertise, and I heard a lot of good things about you from a good friend, Lucas.
Thank you.
So I think we can just get started. You can please also introduce yourself a little bit.
Sure, yeah.
Please.
So I'm the founder and managing director of a multi-award-winning advisory firm headquartered in Singapore with presence in Vietnam and Indonesia. So I started Square Associates 10 years ago after spending 13 years in asset management and investment banking in the financial institutions that you mentioned, relatively well-known financial institutions, BNP Paribas, Aberdeen, Deutsche Bank, Tokio Marine. And for the past 10 years, been focused on Square Associates. So we are a multi-award-winning advisory firm. We are also multidisciplinary. So we have 4 lines of business. We've added a 4th one very recently, and I'm sure we're going to get to that one when we're going to discuss asset allocation and gold and crypto. But basically, the 4 lines of business that we're involved in are strategic advisory, financial advisory, investments, and wealth management. The strategic advisory, that's the part of the cerebral part of the business where we provide strategic advice to the senior management of companies. Financial advisory, that's more the muscular activity, capital raising, merger and acquisitions, the investment banking activity for companies in different stages of growth, different geographies, and different sectors, although we have a bit of a focus on emerging market. But that being said, we are also active in developed economies. And so investments, that's the more that's a relatively recent line of business that we started 3 years ago. This is where we invest alongside a group of high net worth individual and family offices that have accompanied us in the past. And the more recent line of business, wealth management, where we partnered with an MAS licensed wealth management platform in Singapore, which manages more than $3 billion worth of assets. And we advise clients and family offices on how to allocate their investments, their holdings, their wealth into different strategies. So in a nutshell, that's who we are. And we are quite anchored in Asia, but we have partnerships across the world, in the Middle East, in London, and in Africa. And as I mentioned, we're a multi-award-winning advisory firm. We won several awards: Best Boutique Advisory, Top Emerging Market Consultant, and a few awards like that. So that's who we are in a nutshell.
Impressive and so interesting. And congratulations with the awards.
Thank you.
I'm pretty sure it's going to be more coming soon.
Thank you. We hope so.
Probably it will. And I think it's so interesting to talk about geopolitics and economy, especially today. I would just mention Robert Kiyosaki is a guy I've been following for years, and his team, and Mike Maloney, and Peter Schiff, and all these people who advise people on economy. And you need to learn history as well then if you're going to understand economy. But that's what we're going to talk about today. So we're going to talk about can you explain how the Gulf conflict is impacting the Chinese economy in practical terms?
Yeah, I mean, let's take a step back and also and admit to ourselves that politics and economics are intertwined. Whether we like it or not, these two things go hand in hand. And obviously, the conflict in the Gulf, where we have presence through our partnerships, but also through clients and through investments that we've made, and that's a region that I visit quite often. We have to admit that the conflict in the Gulf has repercussions across the world, and certainly in Asia, where Square Associate is very present and where we are headquartered in Singapore. And I think if we want to look at the impact on Asia, as I mentioned, this is our area of predilection. it's a tale of different countries, or several countries, not tale of two cities, but tale of different countries. On the one hand, first of all, let's agree that it affects negatively all countries, but to different extents. On the one hand, we have the countries that are highly dependent on oil in particular, but also Middle Eastern oil. And this is where we can have the categories of Japan and South Korea that are heavily impacted by that. And we see, attempts from those governments to cope with this issue through rationing or things of that nature. We also have the other groups of nations in Southeast Asia that are not as developed or as wealthy as those two nations, and are highly dependent on oil subsidies. So here the weight is more on government finances. And in that bucket, we can put Vietnam and Thailand, for example, Indonesia also, that are reading from that. And to the lesser extent of negatively affected countries, we can put China. And I think this is the more interesting bit. We've all heard the statistics that are whereby China is heavily dependent on Middle East oil, which is true. However, we have to put that into context of the larger independence of China in terms of energy compared to if we compare it to its self-dependency versus its imported energy needs. And here, what we need to remember is that China is self-dependent in energy to more than 80% of its energy sources. So that already reduces the impact of that conflict on its economy. I'm not saying that it doesn't affect it negatively; it does, but to much lesser extent than other countries, just because 80% of its energy needs is fulfilled from self-owned sources, and for that they have to thank coal. They have a big percentage of energy sourced from coal, but also renewable energy. As we know, China is a big player in renewable energy, solar, hydro, and also nuclear. So within that diverse set of countries in Asia, all of them being negatively affected, China seems to be the less affected, and the other nations, to varying degree, are negatively affected or very negatively affected. And obviously, this has some investment implications, which I'm sure we're going to touch on. But already, this is on the economic side. In addition to that, and without delving too deep into that, into geopolitics, there are more longer term implications about that conflict in terms of the multipolarity of this world, how power is going to be distributed and not unipolar as much as it was before, and how other economic systems, predominantly in the East, might be competing with the predominant Western capitalistic American model going forward.
Very interesting. And you mentioned China a lot, but I'm from India, so I was wondering, can you mention a little bit of India as well? Because these two countries are the most populated in the world, so obviously both countries they need energy, obviously.
Yeah, absolutely. And India imports a lot of oil from the Gulf, also negatively impacted. However, managed to secure some supplies from the Middle East on an ad hoc basis in negotiation with the Iranian government or the Iranian authorities. Clearly, India is also in the bucket of negatively affected economies due to its high dependence on imported fuel, imported oil for its economy. The slight mitigating factor for India is that 70% of its GDP comes from domestic consumption. So there is a bit of moat around any external shocks, and I'm not saying it's completely shielded from that, but that is going to be one of the mitigating factor. However, inflation, which is ultimately something that's going to hit India, Indonesia, and some of these other Philippines as well in Asia, some of these countries are going to really be badly hurt from inflation. And I anticipate the governments of these countries will come up with some alleviating measures to help with that, because inflation in those countries is just it's unbearable for anybody, but in particular for these nations, it's going to be very, very difficult.
Yeah, it seems so, and I think already we need to touch a little bit on actually what's happening now. The M2 monetary system, the Western system, and the petrodollar has a big saying in all of this. And basically what happened after in 1971 when Nixon took basically the US off the gold standard. And basically what has happened since then and what's happening now. And you can see the BRIC countries are creating a new currency, or they want to use gold again. And maybe you can touch into these things because I think they are very important for people to understand.
Yeah, I mean, this is a hugely important topic and one that is quite complex, but let's try to simplify it and make it interesting. And we can delve deeper if it's needed. So, as you mentioned, the abandonment of the pegging of the US dollar to gold in the early 70s have changed the monetary system globally and made the dollar as good as gold. That was the expression used back then, and facilitated. Clearly, it had some very advantageous features to it. The negative side of it, at least from an emerging market point of view, is that they're highly dependent on the US dollar as a currency, highly dependent on the US financial system. As we know, all US dollar transactions have to go through either American banks or under the purview of the Federal Reserve or American authorities. In addition to that, um, the credit card companies in the US have such a dominant position worldwide as a consequence of these moves in the 1970s. Now, what we're seeing for the past 10, 15 years is an attempt, and I say an attempt by emerging markets to move away from that dominance. And this is when the BRICS countries have been attempting for many years, unsuccessfully, but attempting for many years to have an alternative currency. Now, what one of the consequences of the conflict in the Gulf seems to have accelerated the need or the push for the yuan as a potential alternative currency. Again, we're still far from it being the dominant currency. If we look at the percentage of transactions globally where the yuan has been used, the Chinese currency, it's only up to 8% as of last year. Clearly, with what's happening now, and if we extrapolate the current conditions to the future, we might see this going up from 8% to a higher percentage, and that stands to change dramatically. The US recognizes that risk to their own financial system, but nevertheless, that seems to be a force that is quite difficult to stop. Or when all these countries want to have an alternative to the US dollar, it doesn't mean that the US dollar will disappear completely. Far from it, but we might see a more diversified basket of currencies being used globally. Now, what has helped, and this is where this is also quite interesting, what has helped is that most commodities, nearly all commodities, are denominated in US dollars, starting with oil, but all the other commodities, which forces nations that trade these commodities to transact in US dollar. If we move away from that, then that's a start to move away from the US dollar. In any case, if we look at central banks over the past 10 years, actually over the past 18 years, ever since the global financial crisis, they have been steadily diversifying their currency basket away from the dollar to the benefit of gold, but also a bit of other currencies as well: euro, yen, and very little Chinese yuan. So there is a willingness and a trend that is being set there, and that's one of the reasons why we see gold on this spectacular rally over the past few years. We just need to plot it against the gold holdings of central banks, and we see a great correlation there.
A very good answer, everything. But I think that is why maybe what's really happening now when it comes to the Strait of Hormuz, and is that why US went into Venezuela and the global marketing now and the inflation we already see? Is this because everything you said now? This is like it's been like big war between China and US for a while now when it comes to basically the market and stuff, and yeah, these type of things.
If we look at it from the Chinese perspective,
Trading war.
again, us being an Asian-based advisory firm, the view that we can offer is the view of the investors, regulators, decision makers that we talk to all the time. The view from the Chinese standpoint is that it's not necessarily a war with the US, but definitely a competition. So they view each other, or at least the Chinese would like to see themselves as competitors to the US on several aspects. Definitely on the economic aspect as well as the technological aspect. With regards to conflict and war and all of that, and again, this is the point of view that we can offer us being based in Asia. One has to understand the mindset of the Chinese decision makers. They view conflict and wars and all of that as a measure of last resort. They really shy away from it. And in the mindset of the Chinese Communist Party and Chinese in general, as a culture, wars and conflict are really the last measure that they need to employ for several reasons. The first one is they view wars as a lose-lose proposition in general. Even if there's a winner in a war, the winner has to expend so much resources that the net gains are very difficult to substantiate in a war. Not only that, again, if we put ourselves in the shoes of the Chinese decision makers, all of the presidents that have come to China over the past 50, ever since Deng Xiaoping in the 70s, all of them, including President Xi, view themselves as the bearers of a mission of putting pushing China to further and further economic progress, technological progress. And with that, that's a common objective for all of them. Now, how they achieve it might be slightly different, but that's how they view their objective. And wars in their mind are an obstacle, or something that deters them from that objective or delays that objective. So uh, this is a bit of a long answer to a very simple question, but this is just to understand how allergic Chinese are generally towards war. And also, let's also remember one of their most famous generals, Sun Tzu, who's always said that the most skilled warriors are the ones that win battles without actually conducting a battle, and we're just winning the war without conducting one. And so that's very much sums up the Chinese mindset. So from that point of view, I think that a direct conflict in the US is not a zero probability, but it's a measure of last resort. And they really put the competition on the economic and the technological front. And we've seen China made huge progress over the past decades on those aspects.
And it's very interesting. And it seems like you see that China will become the global superpower then in a few years, and they will be self-sufficient when it comes to more energy.
They are definitely on the way of becoming self-sufficient. As I mentioned already, they are at more than 80% self-sufficiency in terms of energy, and they're only looking to increase that rather than decrease that. Now, with regards to China being the dominant economic power, I still think that the US still has a very strong weight economically worldwide and will continue to do so, all the while acknowledging that, and this is not just me saying, I think that there's a broad consensus around this, that if you look at it as the cycle of an empire, it seems to be at the peak or at the top of that. But that doesn't mean by any stretch of the imagination that it's going to disappear altogether. The US will still hold a big weight economically worldwide, and also on the innovation front. And this is, I think, where China needs to do more, has more progress to do, more improvement to do, is that China still is a very good marginal improver of technology, but still not a leading innovator in terms of technologies. So we're still seeing the home of innovation being the US, largely, just to simplify it in broad terms. And China is the marginal improver on these existing technologies. But in terms of disruption, we're still not seeing large corporations or large disruptive ideas coming from China. We're seeing marginal improvements coming from there. So, in a nutshell, I think we're going towards a multipolar world rather than a unipolar world, and where one is dominated by one economic force. And I think the global south or emerging markets, whatever we want to call them, will have more and more say going forward economically and maybe even politically going forward.
Think so too. But it seems to me that the Western countries are not that very fond of that idea, because they are used to been dominating Africa, Eastern Asia, and these type of countries. Way back when you look back to imperialism and colonization as well. So it seems to me that it's a very new idea for them that is going to be a multipolar world. And how do you predict that future will be when it comes for normal people to live, but also when it comes to trading and other countries, the whole geopolitical situation? It
Yeah, I
seems
mean,
we are in a change.
clearly it's a geopolitical seismic shift for sure, and there needs to be adjustments. But there's also clearly opportunities, and I think this is being recognized by a lot of important actors in Western economies. The companies, the large corporations, or even small ones that are recognizing the opportunities in Asia, in emerging market, in the global South, are putting their money where their mouth is in terms of expressing those views, positive views, bullish views on the rise of emerging markets and global South economies as having more place in the global economy, and therefore it's not necessarily all threat and no opportunity. Obviously, it might be a threat, but it's also equally an opportunity for them. And we're seeing a lot of corporations diversifying their exposure, investing in definitely in Asia. I mean, we're seeing that we've seen that over the past decades. The current visit of the American president to China, as we speak, is an expression of that. Particularly that he brought with him, the CEOs of very large, very notable corporations on that trip, clearly marking or clearly expressing that this is going to be a business driven trip. And what is sought after are some of the results that are hoped for from that trip are economic benefits for these corporations and therefore to America and to American citizens directly or indirectly. So to answer your question, maybe a threat, but also an opportunity. There is some geopolitical shift that might be around that. And that also has an investment implication as well. And that's one of the things that we recommend to our clients, especially in our newly formed wealth management activity, is increasing exposure to emerging markets and not necessarily blindly without any regards for liquidity, because that's another aspect that we need to be cognizant of. Emerging markets are usually less liquid than developed economies, and we still have some very strong corporations in the Western world that deserve being exposed to and invested in. As I mentioned, we still see the home of innovation in the US and in the Western world. But we still need to express the view that this is going to shift a little bit, and from an investment point of view, you're better off with a diversification and increasing exposure for emerging markets. It's also very important to remember that if you go back 20, 30 years ago, when I started my career in investment more than 20 years ago, at that time, having any investments outside of the developed economies, Western Europe and Northern America, was really like a fringe idea or something that is really not part of a core portfolio. Now it has changed dramatically and will continue to do so. And also the allocation to alternatives, private markets, private equity, also that has flourished over the past decades. So investors are usually they're mentally flexible. You always have to adapt to new situations. So it's not something out of the ordinary for them to adjust their portfolios whenever there's a change in what's happening in the economies globally.
Very well said. I agree. And leads me to a question: what would you actually recommend people to invest in now in these difficult times with the inflation? Would it be paper assets, stocks, gold, silver, um, metals? What would you recommend people to do now?
Yeah. So, in consistent with our view that this conflict has implications and potentially negative implications on inflation, on economies worldwide. The recommended view from our side to our clients on the wealth management side is a gradual increase of their fixed income exposure and a gradual decrease of their global equities or equities exposure in general from a top-down point of view. And that's predicated on the fact that we are likely to see inflation pressures at least for the next 6 months at the very least. Even if everything is resolved now and the conflict is resolved now, we are still going to see some negative consequences for at least 6 months and potentially even more. And these consequences, as I mentioned, are, among other things, an increase in inflation, which is always associated with a hike in interest rates globally, which is what is going with the likely outcome of the next 6 months in our view. And if that happens, then fixed income instruments are usually preferred to equities in that kind of situation. As earnings gets squeezed, stocks get negatively affected by these earnings being reduced or lesser than expected. The higher interest rate on the fixed income instruments becomes a more attractive proposition for investors. So rebalancing of that portfolio is better. But it's very important to mention that this top-down recommendation of increasing fixed income gradually and decreasing equities in parallel to that is predicated on this exogenous shock of inflation, imported inflation, higher energy prices, oil shortages that we're likely to see over the next year, and not related to the fundamentals of the companies. So if it weren't for that, we would still have a bullish view on corporate earnings in most economies, and particular in developed economies. We would still have a positive view on the earning cycles going forward there, but that exogenous factor is going to put a halt on that earnings progression. So this is why we would not recommend a full blown complete reduction of equities, increase of money market exposure and cash, and increase in fixed income, but a gradual shift along those sides. So that's with regards to public markets. With regards to metals, our view on gold is that this is a long-term trend. By this, I mean, I won't say U.S. debasement, but the U.S. dollar being less favored by other nations is an inexorable trend. The fact that government deficits are, governments are still printing deficits left, right, and center, and that's usually negative for fiat currencies and positive for gold and precious metals in general. And this is a trend that is not going to be reversed anytime soon. So because of that, we think that gold should be a core holding in any diversified portfolio. We would look at adding to that on any dips. A bit similar to silver, although silver is a bit more speculative, more volatile. So there, we would advise more trading positions rather than long-term investment positions. Gold is definitely a long-term investment recommendation for our clients on the wealth management side. With regards to crypto, crypto is a bit the way we view it is more from a trading angle rather than investment angle, and let me explain what I mean by that. We definitely recognize the advantages of a digital currency. And this is not just us saying, this is central banks globally who are trying to experiment with central bank backed digital currencies. We've seen that with the UAE central bank, the Chinese central bank, and others. They are trying to have their own digital currency backed by a government. So there's definitely a need for a digital currency. Now, will that digital currency be Bitcoin in 10 years from now or something else? That's a difficult question to answer. So this is why we take the view that Bitcoin in particular, we don't necessarily look at all the other cryptocurrencies, but Bitcoin is more of a trading instrument rather than an investing instrument. It doesn't have the characteristic of a investable asset class, but definitely has characteristics of a trading asset class. So that's the way we view a broad portfolio. Now, one of the advantages and one of the added values that we bring in our wealth management practice is customizable portfolios, and we're able to do that because we, through our wealth management partner, we have access to a broad range of private banks and other custody solutions and investment solutions. And because of that, we are able to customize portfolios to a high level, to a high degree. So really, it goes back to the individual or the family office's preference in terms of liquidity, risk appetite, and long-term versus short-term return objectives. So a bit of a long answer, but that's how we view the asset allocation question.
A very good answer. It was. Can you please explain as well why, in these crises, people go back to gold and metals? One thing I want to add is because gold and silver, it's not materials that grows on Earth. They are from the universe. They are creating when there are explosions. So it's been meteors who have been hitting the Earth, and then you will find gold and silver because of that. So, but why is that? When it seems to me throughout history, when you go off the gold standard, a lot of civilizations have tried many years ago as well, and they go over to a paper assets or a normal coin, which is not gold and silver backed by it. It seems to me that it will never last. Why is it like that?
Yeah, I mean that's a very interesting question, particularly that my background is economics as well as business management. So we can definitely discuss this at length. You're right. So these metals are not naturally indigenous to Earth, but the attraction of gold. There are several reasons. Gold and silver, the attraction for them is severalfold. First of all, these are rare metals. They're precious. Already, their scarcity makes them already attractive. Not only that, they have multiple uses. They have an industrial use, so they can be used in industrial processes. So it's not like something that like a diamond, or even diamond has a industrial use, but it's not like something that sits on a shelf and sits pretty and doesn't do anything. It has an actual use. Not only that, it has, historically over thousands of years been used as a means of exchange. So, and that's the longest used means of exchange ever. The U.S. dollar is a new phenomenon. It's only a couple of 100 years old, whereas gold is thousands of years old as a means of exchange. So, the one that will outlast the other, we're very clear on which one is likely to outlast the other. So because of that, there's this tendency to revert back to these metals because they have these universally accepted utility, universally accepted worth. That worth might fluctuate, but it's universally accepted that they have a certain worth. Whereas a piece of paper, if something happens to the U.S. economy, low probability, high impact scenario, the piece of paper on which the dollar is printed is worthless. So for that reason, there's this appeal towards precious metals. And central banks have been acting according to that premise that I just mentioned. And we also see a very high correlation between gold and real rates. And so in an inflationary environment, gold is seen as a hedge, but also in a deflationary environment as well. So for all these reasons, gold has a use. Now, one of the main criticism that asset allocators might give gold is that it doesn't yield you anything. It doesn't earn you anything. There's no interest, etc. So one of the things that we advise our clients is that if your objective is really more short term and less long term than holding gold because it's a hedge against inflation or potential deflation, one can revert to investing in gold mining stocks. And there are several ways to do that, several ETFs that can do that, because these companies not only are a high beta bet on gold, but also distribute dividends, as soon as they start selling gold and making profit. So that's a way of getting some yield, some dividend, some return on a gold exposure. So these are some of the methods that one can use if you want to get exposure to gold. And reduce your risk towards inflation, deflation, and basically if you're sensitive towards real rates in general.
Very, very well spoken. I agree. And I leave so many new questions all the time, but it's very interesting. And I was wondering as well then, because we are in this crisis where we are now, or where everything is going up, what are the biggest mistakes investors make during volatile periods?
That's a very, very broad question. There are several. There are several type of mistakes. Well, usually, if we can summarize them to a couple, is that it's either an overestimation or underestimation of risks. I think we can summarize the mistakes around that. So one might say, for example, that there might be an underestimation of the inflation risk if you're looking purely at U.S. equities, and the bond market already has moved towards a higher risk of inflation, albeit not to the fullest extent of inflation risk being priced in the bond market. But on the equity side, we're not seeing the same movement so far. So here we have a scenario, we have a situation where there is some form of adequate risk pricing on the bond side, in the bond market, but not adequate pricing of risks on the equity side. And this is one of the typical situations that we have in these kind of conflicts. Either we overestimate the risk or we underestimate the risk. Um, and it- and usually I mean, that's what we've seen. Underestimation is a more common phenomenon than overestimation. It usually is the case that investors underestimate risk rather than overestimate. That's a personal observation from working in financial markets for the past 20 years.
Thank you. Um, and how can family offices position themselves for the next 12 months?
Yeah. So as I mentioned, on the asset allocation side, our recommendation is increasing the fixed income exposure gradually, reducing the equities exposure gradually. And the reason behind this gradual shift is because, as I mentioned, there's nothing fundamentally wrong with the underlying markets. Is that what is wrong is that we have an exogenous shock that's going to affect us for at least 6 months, maybe even longer. And therefore, a gradual repositioning on these two asset classes is warranted. On the gold side, as mentioned, buying dips, we have a long-term bullish view on gold, and we think that public deficits, fiat currencies, and all of that we discussed is a long-term trend, and gold is a mainstay, should be a mainstay, and in these portfolios. On the private equity, venture capital, alternative side, our view is slightly different from other wealth management advisors out there because we are able to source very attractive private market deals from our advisory practice. Our view is on the alternative side, not necessarily to change the allocation, but always be on the lookout for these unique opportunities that thankfully we have access to thanks to our advisory practice, where we have asymmetric risk return profiles, basically where the risks are relatively lower than the returns that you can potentially get from these private market situations. So on the alternative side, we're not recommending necessarily a change in the allocation there, but always being attracted to those unique opportunities where you have asymmetric return profiles. And on the crypto side, as I mentioned, that's more trading. And we only recommend the trading positions there rather than long-term investing. So broadly, that's on the asset class side of things. Quickly, keeping a diversified view, we think the developed markets and in particular US market is a bit richer compared to emerging markets. So we recommend on the geographic diversification, reducing the US equities in favor of Asian equities or emerging market equities broadly. And on the credit side, we still think that high yield, uh, in spite of the fact that high yield is a very interesting asset class, and I know that because I've worked on the credit side of the business and asset management for a long time, and high yield can be an outstanding asset class from a risk return perspective. Currently, it is not pricing in what it should be pricing in terms of risk. At least it's not giving you the real returns that you should be getting. So we have a slight preference for investment grade over high yield currently. So that's broadly on the top down view. And as I mentioned, we like to personalize and customize portfolios as much as possible, and that's what we do for our individual clients.
Very, very good. Very good. And I was also wondering then, when it comes to Bitcoin, if you can explain it, or crypto, very fast for people who don't really know what it is, because a lot of people are not into it. What would you say it really is now? Is technology, but how does that very fast work?
Yeah, I mean, it's a digital currency backed by a very interesting infrastructure, which is blockchain. So the infrastructure itself is not in question. Everyone thinks that blockchain has a real, a real use case, albeit investments in blockchain related companies have decreased, and it seems to be a very heavy infrastructure to be carrying around, but it has some use. Once we figure out how a blockchain can be made more energy efficient, less cumbersome on global systems, I think it will be even more widely adopted. But so that's the infrastructure layer upon which Bitcoin sits. And as I mentioned, digital currency have a real life use. It can be used. However, will Bitcoin be the surviving technology or the surviving currency going forward? That's an open question. But digital currencies have a use, and I think going forward we'll see more of them. But it might be the case that the future is for centrally backed digital currencies, CBDCs, rather than the currencies that are completely independent from any authority. Again, open question. It really depends how things go forward. But crypto, that's one of the reasons why we have a trading view rather than investing view on crypto and Bitcoin in particular, because of these uncertainties that are quite high. And in any case, we see that in the patterns of crypto trading. It trades as a means of transaction, but it's not a store of value, definitely not a store of value yet, like gold. And I know that the comparison between crypto and gold is very prevalent among the investment community, but our view is that these two are absolutely not the same. I know that a lot of people in the investment community like to see them as inflation hedges, both of them, gold and Bitcoin. But our view is that one is a real inflation hedge like gold, whereas crypto is a very good means to transact, but not yet as a reserve of value. When you go back to the fundamentals of a currency has two uses. It's a means to transact, and that's one of the reasons why paper dollar has helped economies worldwide to grow, because it facilitated transactions as opposed to bartering gold or metals every time you want to do a transaction. Exchanging paper is easier, so it fosters transactions and international trade. So that's one of the use cases of currency. The other use case is a store of value, but the cryptocurrency haven't proven that they are a store of value yet.
Okay, interesting, everything you say. I'm just taking everything in. But for me, it seems like crypto was more or less created, so it could be decentralized from the banks. It could be an opportunity for all people, everyone in the world, to create some money and not be having this connection with the banks. It seemed to me that was the main reason for it. And I know that Solana is a different coin. They are doing a lot with their technology now when it comes to the blockchain there. So it seems like I think it's here to stay. It's just seeing what kind of systems they will be used for in the technology, because it seems to me that people believe in crypto and Bitcoin especially. And especially people who were into it very early when they started to mining it, because it's still worth a lot, and people believe in it. So,
Yeah,
and
I mean,
it's that's
it is ironic that ultimately central banks are looking to issue their own digital currencies because, like you mentioned, the if you look at the genesis of Bitcoin with the paper by Satoshi Nakamura. The original white paper on Bitcoin was that it's going to be independent of any authority, decentralized, etc., which conceptually sounds very interesting for sure. But what turns out to be the case is that there still needs to be a high level of trust for any currency to foster for a long period of time. And as of now, we still need to rely on institutions to provide that trust. I'm not saying it's going to stay like that forever. Things might change going forward. But as of today, we still need to have the buck stopping somewhere with someone, with an institution that we can point the finger to and saying, you are responsible for this. Therefore, either I'm putting my trust or I'm taking away my trust from you. But it needs to be a bit substantiated. And again, it might change in the future. I'm not at all disputing that. But as of now, we're not at that point yet. We're not at that point yet.
No, very interesting, and I agree. We are not at that point yet. But it seems to me then what you said, that we need someone to trust. So the petrodollar was basically a promise then. And as long as you have people who believe in some kind of currency, then it's okay. And that currency is doing good in the country and a lot of people use it. That makes it valuable. But if you print up too much of it, then it's not like a painting anymore because it's so much of it and it's only one painting maybe of the Mona Lisa. So it's not very, it doesn't like, the monetary system is very complicated. It doesn't make sense that much. And for me, when it seems to money is connected to energy, and now we need oil. So it doesn't seem very smart that they put so much energy out of one place, like the Strait of Hormuz. It doesn't seem to be very smart when it comes to the whole world to put all eggs in one basket, if you know what I mean, when it can be crisis like we are in today. Because we are a lot of people in this world and it affects a lot of people.
Yeah, I mean, going back to your point on the value of paper and currency being printed, if you look at economic history, as I mentioned, my background is an economist, so I have a certain sensitivity towards these topics. If you look at economic history, it has always been the case that printing money or the use of a certain currency has always been in parallel with a certain creation of wealth, creation of assets, creation of something. But over the past 20, 30 years, we are seeing a divergence from that premise. So we are seeing a printing of money without necessarily an equal creation of wealth or accumulation of assets that is commensurate with that printing of money and of currency. So that's one of the reasons why we hear a lot about debasement of currency, debasement of US dollar, the bullish view on gold because of that. Because we're starting to see a dichotomy. And it's not like we haven't had episodes like that in the past. We've had episodes in the past where there was a temptation that was realized actually of printing more paper than the economy justifies it. So we had hyperinflation scenarios in many countries, like in Germany pre the Second World War, in Zimbabwe, in many countries, we've had these situations, and ultimately that creates economic crisis, and then you have a self-regulating mechanism. That crisis creates destruction of value, reduction of the value of currency, and then we revert back to some sanity. So we may be in a situation like that as we speak, and at some point, if we continue on that trajectory, we may have a crisis. And actually, that's a bigger topic that we can discuss. I think if there is any crisis going forward, it's not necessarily AI in my view, or a bubble in AI, although maybe valuations can be high in certain cases. Or it's not, in my view, private credit markets, because I don't know if you've been following private credit markets, but there's been a lot of talk that there might be a crisis because of what's happening there. I don't see those as a real crisis from the scale of the global financial market of the Great Depression, but we may have a very big crisis if investors come to a realization that one of these large governments, strong governments, whether it's the US or Western Europe, are not credit worthy anymore. And this will be a seismic shift. And this is where we will have some serious, serious problems if investors get to that conclusion all at the same time. We're not there yet. We might be inching closer to that conclusion. But if that happens, then this will be a real crisis, and not a bit of overvaluation in AI or some froth in the private credit market, in my view, at least.
Yeah, I mean, it seems to me that other people have been talking about maybe a housing crisis. But everything depends if the US dollar, if that doesn't, if the other currencies will take over. And I think that's like, it seems to me that then it could be, the Western economy at least will collapse for what you were saying now. But it seems like it's backed up by the promise that people in the world still needs to use and trade in the petrodollar, basically.
Yeah, as I
That's
mentioned,
what you're saying.
it's all predicated on that trust that investors have
Yes.
in those governments, that they are behind their currency, and there's someone strong creditors, strong issuer of that currency. If that hypothesis, if that premise, if that assumption breaks down, then we are in for a world of hurt. I'm not saying it's gonna break down anytime soon, but if we extrapolate things as they are now for many years ahead, then it could be a situation. Yes, yeah, it could be. But we also have to bear in mind that economic events, like any events, they're dynamic. Whenever there's an action, there's a reaction. And if we are sitting here and we realize this, and other people in the investment community are realizing this, regulators are also cognizant to some extent of those risks and will have to put in place some safeguards, or one would hope they would put some safeguard against that. And actually, that opens a very interesting topic. I think that's one of the reasons why, me personally, I think that universal basic income is something that is inevitable also for most economies, and particularly starting with developed economies, because we are at a point where that printing of money needs to be reined in, and one way to do that, although it's a long the logic, it takes a bit more time to articulate than we have today, but the conclusion is that that's a driving force, that's a catalyst for universal basic income to be introduced in economies, in my view.
Okay. Yeah. Interesting. Very interesting. And I was wondering as well, Asia and Africa and those countries who are really coming up now, what will you see the change there now in the future mostly? Is that on technology, or is it that more of the poor population will come up to the middle class and people will be more rich there? The upcoming countries like India, for example.
I mean, definitely if we look at how China and Asia over the past 30 years, how they have evolved, if we are going to point at one factor that really explains this economic explosion that we've seen, is the increase in the middle class, the rise of the middle class in number, but also in purchasing power. So that is, if we're going to look at only one factor, although there are other factors, but if we're going to look at one factor, it's that. And I think the same thing is likely to happen in Africa, where we haven't seen that explosion of the middle class, and that brings with it a whole change in the economy and the investment implication, the investment themes that you invest in once you have that. Because over the past 30 years, that has really helped Asia and China in particular to a greater prosperity, and moving 300 million people in the case of China from under the poverty line to middle class. So I think this is a phenomenon that is likely to happen in Africa. In Asia, the demographic dynamics are not as strong as in Africa. You still have some countries that have high population growth, whether it's India, Philippines, Thailand, although they're starting to plateau themselves as well. And we have some countries like Japan, China, South Korea, Singapore, who are already having a population crisis in terms of reduction of their indigenous population and likely to be accelerated going forward. So for Asia, it's not the demographic dividend that one might expect, but it's the technological dividend that we can expect to really drive that region going forward. The investments that China are making in its economy and particularly in technology are really impressive, but other nations as well. You mentioned India. We are seeing a very strong push from the current administration in India. This is something that's been in the private sector for many years, but now we're seeing the public sector taking a very strong interest in pushing forward that economic agenda, that technological agenda for the country. And, if India joins the party in full force, that's going to be tremendous because it's already the largest, the most populous nation on earth. It surpassed China in terms of population more than a year ago. So any marginal changes in India stands to have dramatic impact economically worldwide.
I really hope that Asia is coming up with so many intelligent and smart people over there. In a lot of different things, especially in music because I've been involved in that, but in business as well. And yeah, you are one of them. So it's really amazing to see such a nice part of the world is coming up, and I hope with Africa too.
I hope so, especially that, as I mentioned, the technological prospects prospects of technological improvements in those countries tend to have an outsized impact. So it stands to really benefit them, and also it's a region that is less prone to conflict, less prone to wars, and these kind of events tend to put a stop on economic development. So we're not likely to see, I'm not saying it's zero probability, but we're not likely to see these kind of events stopping economic progress in in that region, Asia Pacific. So we still are quite bullish on that region, all the while acknowledging that it's going through some challenges like the rest of the world currently.
Indeed, it is. Um, just very fast as well with the AI. Everyone is going for it now. All the countries. It seems to me that they are really investing billions of dollars for this type of technology now. How do you think that will change the economy?
I mean, in every single aspect possible, the most important technological innovation, I think, ever. I mean, the internet was not even close to how important AI is in terms of potential improvement to and change to our societies. We've already integrated AI in our work in Square Associates and in our advisory work, and it has improved our productivity tremendously, 5 to 10 folds on average in terms of productivity improvement. And the same can be said to so many other domains and sectors. No, I mean, definitely there will be the before and after AI technological innovation for sure. And it's going to affect us in very deep ways, not just economically, but also from a societal point of view. And again, we go back to the universal basic income discussion. I think that's another catalyst, another reason why it might be inevitable that we have some form of social programs like universal basic income, because it will be needed. It will be needed in the age of, there will be some job losses. It's inevitable. It doesn't mean that there are no new jobs being created because of it, but net, I think we might see a net reduction of jobs. But that also goes in tandem with a global reduction in population. So if we look at 10 years from now, even longer than that, 30 years or 50 years from now, global population is expected to shrink. So what I'm trying to say is that it's not as catastrophic as people make it. And it's definitely a very important, the most important technological innovation we've seen in our lifetime, for sure.
Yeah, I think so too. I think it's very exciting and makes my life at least a lot easier and faster. And I think it's good. But of course, people are questioning if it's get developed and too smart, too fast. But I don't know, and that could maybe be a conversation for another time. But I do also have uh, one questions, few questions more that I ask everyone who is a guest on the podcast. So you have done so much already. So what are your dreams now and your plans forward in life?
Oh, so dreams are different from plans. World domination. No, I'm joking. But
Yeah,
for
yeah.
Square
Why not?
Associates, I know on the Square Social side, definitely continuing the strong growth that the company has experienced over the past 10 years. And we look forward that the next 10 years will be even more exciting, more fast paced than the first 10 years. We really look forward to, increase our geographic exposure, increase our entrenchment with corporations, and continue our work with investors on how to advise them on their investments and and structuring their investment solutions for them. So that's on the business side. On the personal side, what's my dream is it's a bit personal. You know, just um, getting these professional objectives achieved. Basically, the way I view it is that once an objective, I don't have dreams, I have objectives. Once is achieved, I look forward to the next one. Hopefully, this is going to pan out as I hope it is.
Very, very well said. And I would also and Fortitude, which is the name of the podcast. It means strength. So, what kind of methods, techniques have you used in life, in your personal life, and in business against adversity and hard times?
Oh yeah, so a very interesting question, and more on the introspective personal side. Um, I think it's very important to always be level-headed and accept the positive and the negative in the same way. At least that's how I managed it. So a relatively stoic approach, because when you're in the investment world, you have to deal with uncertainty, with risks all the time, and you cannot afford to be swayed by emotions, subjectivity, and all of that. Keeping a cool head in bad times as well as in good times is always key for survival. So that's on the business approach side. Uh, Working with our clients, I think being listening to our clients is very important. I know it sounds really redundant, repetitive, but I really mean it. Like listening to clients, listening to problems as a first step rather than imposing solutions that we think work. At least in our case, that has helped us a lot. And that has allowed us to really have a personalized and customizable approach to our services with our clients. And we hope that that's why they chose us.
Very good. And if there are people who want to contact you and work with your um, firm, your company, and get help and advices, where can they contact you?
Yeah, so on our website, www.square-associates.com, our LinkedIn page. Also, you can search for Square Associates Singapore on LinkedIn. And we have our the company's email address, info@squareassociates.com. And you can contact us there. And we'll be happy to see how we can help.
Perfect. And I'll leave those links in the show notes as well. Yeah, it's been very interesting. And I would just say thank you for your time. I learned a lot, and I know that my listeners will too. It was an honor to have you on the Fortitude and Flow, the podcast. So
Thank you
thank
for
you.
the invite, Frederick. It's been a pleasure. And thanks for the invite.
Thank you very much.
Take care. Bye.
If you liked this episode, it would mean a lot if you liked, shared, and subscribed, and left a comment with any ideas how to improve the podcast. All of this would really help the podcast grow. Thank you for your support.